What is the impact of inflation on purchasing power? Inflation, the rate at which the general level of prices for goods and services rises, has a profound impact on purchasing power. Understanding these effects is crucial for individuals, businesses, and policymakers. 1. Reduced value of money. As inflation increases, the value of money decreases. This means that each unit of currency buys fewer goods and services than before, eroding purchasing power. For example, if inflation is 3%, an item that cost $100 a year ago would now cost $103. 2. Cost of living. Inflation typically raises the cost of living. Everyday expenses such as groceries, housing, and utilities become more expensive. This increase can strain household budgets, especially if income growth does not keep pace with inflation. 3. Fixed incomes. Individuals on fixed incomes, such as retirees receiving pensions, are particularly vulnerable to inflation. Their income remains constant while prices rise, diminishing their ability to afford the same standard of living over time. 4. Savings erosion. Inflation erodes the value of savings. Money kept in a savings account with low interest rates may lose value in real terms if the interest earned is less than the inflation rate. This can discourage saving and impact financial planning. 5. Interest rates. To combat inflation, central banks may raise interest rates. Higher interest rates can lead to increased borrowing costs for consumers and businesses, affecting spending and investment decisions. This can slow down economic growth but helps control inflation. 6. Wage adjustments. While inflation can lead to wage increases, these adjustments often lag behind price increases. Workers may find their real income, or purchasing power, decreasing even if they receive nominal wage raises, affecting their overall financial well-being. 7. Business costs. For businesses, inflation increases the cost of raw materials, labor, and other inputs. Companies may pass these costs on to consumers in the form of higher prices, contributing to a cycle of inflation. Alternatively, they may absorb the costs, reducing profit margins. 8. Investment returns. Inflation can impact investment returns. Fixed income investments like bonds may offer returns that do not keep pace with inflation, leading to real losses. Conversely, investments in assets like real estate or stocks, which often appreciate with inflation, may offer better protection against purchasing power erosion. 9. Consumer behavior. High inflation can change consumer behavior. As prices rise, consumers may prioritize essential purchases and cut back on discretionary spending. This shift can impact businesses that rely on consumer spending for revenue. 10. Economic uncertainty. Persistent inflation creates economic uncertainty. Businesses may delay investments, and consumers might be hesitant to make significant purchases. This uncertainty can slow economic growth and contribute to a less stable economic environment. In summary, inflation reduces purchasing power by increasing the cost of goods and services, affecting individuals and the broader economy. Managing inflation is critical to maintaining economic stability and ensuring that wages, savings, and investments do not lose value over time. Understanding these dynamics helps individuals and businesses plan effectively for the future.